Now I'm telling you, we have started the bear market. It's going to get worse from here, and it will end up being one of the worst trading environments that anyone alive has ever seen.
Welcome to Wealthion. I'm Wealthion founder Adam Taggart. Inflation, as measured by the Consumer Price Index, has hit a new 40-year high this week, printing at a blistering hot 8.5%. This massive rise in inflation over the past year and the double-digit increases in many of the key costs of living, like food, fuel, and housing, is really starting to bite household budgets. A recent NBC News poll reports that 62% of Americans are now saying that their incomes can't keep up with the rising cost of living. So, with all of these very valid reasons to worry about inflation today, are disinflation and deflation actually the bigger threats? Money manager Michael Pento thinks so. In fact, he predicts inflation is peaking right now and that the big risks to focus on are an approaching painful recession and market contraction, perhaps the worst of our lifetimes. To find out why, let's get right to the interview. Michael, thank you so much for joining us today. I'm so glad to have you back on the program. I've had so many people asking me to get you back on. Thanks for joining us.
It's always a pleasure to be on with you, Adam. You're terrific.
You're too kind. All right, well, look, I'm going to hit you with a question I always hit you with every time we have you on the program, which is, and this is just a jumping off point, but what is your current assessment of today's global economy and financial markets?
Oh, geez. Yeah. Where do I begin? I think the first time I was on your program was July of 2021, Wealthion's program.
Yep.
And I said that back then that the rest of the year would be pretty good. I said, but beware of 2022. Then you had me back on in very early January of this year. And I said, by the second quarter, it was my belief that the market could be down 30%. I didn't know Vladimir Putin didn't call me and inform me he was going to invade Ukraine.
What? So he didn't call you?
He didn't call me. He didn't have the courtesy to call me. But that clearly expedited the downturn. I think the average stock by early January, just a few days after our interview, and by the way, in that interview, the stock market ended up that day and I think the following day. It ended the day up substantially. And I thought I was going to be, look like a fool in the very short term because I was so bearish by the second quarter. But clearly the invasion in Ukraine in February expedited the decline. It also served to keep inflation much higher than I thought it was going to be. I'm still in a disinflation camp. I think we just got a print today, as of this recording, of 8.5% consumer price inflation, which, by the way, I go on these tangents, but we have an hour almost, I think, to talk. So 8.5%.
As much as you have, buddy.
8.5% inflation, which again is higher than I thought it would be, because we would be in disinflation right now on the second derivative basis, just a reduction of inflation. That doesn't mean deflation, it just means inflation would be going from 7.9 to say 7 or high 6s if it wasn't for the invasion of Ukraine. But the way the Labor Department counts inflation is bogus. And I know you know that and your audience knows that. If you look at home price appreciation, rent price appreciation, the cost of beef, gas prices, the real rate of inflation is 20%, around 20%, and it's an all-time record high. So I said that Vladimir Putin expedited the turn down in the stock market. I believe now, I don't know if let me just parenthetically add that the average NASDAQ stock was down 50% in early January. So we clearly have had a bear market. But I think the bear market is just beginning. And I think it gets much worse through the second and third quarters of this year. And I believe it could be the most substantial bear market the United States has ever suffered. That's where we are right now. And I want to walk through why I feel that way. Because again, remember, in 2021, when I was first on the Wealthion program, I was still a bull in the stock market, bearish on the structure of the economy, bearish on the Federal Reserve and what they were doing to the foundations of the US economy. I knew it would end in disaster, but still you could be a bull knowing the construction is faulty and will falter. But now I'm telling you, we have started the bear market. It's going to get worse from here, and it will end up being one of the worst trading environments that anyone alive has ever seen.
All right. What I love about you, Michael, is you do not leave room for confusion. You are a direct speaker, and you make very bold predictions. So when we were on, I think back in July, and I think you reiterated it back in January. So I want to let you go and provide all your rationale for why you believe the statements you just made. But I'd love for you to incorporate in your answer a bold statement that you made, which I agree with when you came on earlier in those two appearances, which was, if I remember correctly, you were saying that one of, if not the most defining trends of 2022 was going to be the coincident occurrence of the largest monetary cliff and the largest fiscal cliff in U.S. history. So I'd love for you to weave, that into your answer. I also just want to toss an analogy out there to get your reaction to it. So you talked about how we are currently in a bear market in, the majority of stocks, or at least certainly at the beginning of this year, the first quarter we were. The indices don't reflect that so much, and it's because they're driven by a few stocks that prop everything up, the really big darlings. And I kind of liken it to thinning ice, right? Which is the thickness of the ice is getting less and less and less, but to everybody standing on the surface of the ice still looks flat and solid, right? So you don't really know that the market is being eroded, that the ice depth is being eroded, until so much of it is gone that the whole thing cracks. And so, as they say, bull markets tend to be, sort of the escalator process, but bear markets tend to at least begin with kind of an elevator drop down, right? And that's when the ice cracks, obviously, and you fall through. Appropriate analogy?
Beautiful analogy. Take the stairs up and the window down, I think it is, something like that.
I guess so.
So the S&P 500, as of this recording, is down about 7% for the year. The QQQs and the NASDAQ are down about 14%. But here's something most people don't mention is duration bonds are down 16% on the year. So, you think about that balanced portfolio where you have half of the, 60% in stocks and 40% in bonds, and you just go away and just say, okay, you could be, like a Tom Lee, and just say, in the long run, you'll be fine. Or you could just turn on CNBS for that. You don't need to know anything else except be a long-term holder. That is one of the worst starts we've ever had in the financial markets. And as I said before, it's going to get much worse. So what's holding up the market, you remember the Nifty 50 back in the 60s, Adam? You're not that old.
No, but I remember. I've read about them.
I mean, I can tell you, we don't have the Nifty 50 anymore. We have like the Nifty 5. You have Facebook, Amazon, Google, Microsoft. They're holding up the entire averages, but they're not even doing that great of a job of it. Like I just said, they're down 6% on the S&P 500. But they too will falter, and the generals are the last to go. The pawns go first, and then you have the rooks and the knights and the bishops, and then you have the queens and the kings. So why was I so bearish on 2020? Let's talk about, and I went over this in 2021, and I reiterated it in, like you said, in early 22. First of all, you have the biggest fiscal cliff we've ever seen since World War II. So what does that mean? $6 trillion was handed out to individuals and corporations in 2020 and 2021. $6 trillion. And that caused S&P 500 earnings growth to be 47% in 2021. Now this year, it's still supposed to be between 5 and 10%, depending on who you ask, earnings growth. I think that's ridiculously high. And even if you do get that rather anemic earnings growth as a comparison between the earnings growth of 21, it's going to be in nominal terms, meaning the purchasing power of those earnings has collapsed. Nobody talks about that. I mean, yeah, I mean, if nominal GDP increases by a certain number and then earnings grow by a certain number, because, you know, hopefully you're in a corporation where your revenue is higher than your costs, you're going to increase your earnings in nominal terms. But what does that earnings buy the corporation? No one talks about that. So I also would like to comment that GDP growth was 6.9% in Q4 of 2021. Q1 of this year, which just passed, just ended, will be something more like 1%. And the entire year's GDP, which was about 5.5%, is going to crash from that level closer to, again, 1% or less. We could even be in recession by the end of this year. And now, again, I have a 20-point model. I'm not sitting here making predictions going out years and years and then adhering to that. Well, what does the Federal Reserve do? I think that the Federal Reserve is going to crash the economy completely in the next quarter or two, and then we'll start to re-stimulate the economy through massive QE and universal basic income with the cooperation of the Treasury. That might not happen, by the way, and we'll get into that. But so that was the primary reason why I was bearish coming into this year. Now you add onto that the destructive powers of inflation, which again, if you measure accurately, would be 20%, around that figure, 20%. Then you add on top of that fact that interest rates have absolutely soared. Both short-term rates, long-term rates, corporate borrowing rates, credit card rates, mortgage rates, they're all soaring. It's adding to pressure on the consumer. Then in February, Russia invades Ukraine, which did two things. It further exacerbated and protracted that inflation problem, which is destroying consumers' purchasing power. But it also is going to retard growth substantially. You know, again, you're probably too young to remember this. Well, maybe you were a little baby. In 1998, there was something called long-term capital management. Hedge fund.
How young do you think I am? Of course I remember long-term capital management.
You look like a baby. You look like a baby. Come on, you're such a handsome guy. So long-term capital management almost brought down Russia and the entire economy. Really wreaked havoc across the globe. And I'm asking myself this question: do we know everything that's happening to the shadow banking system, to pension funds, to investment funds, to municipal bonds? Do we know everything is happening to the shadow banking system as in regards to Russia? The economy is in free fall, and their investments have cratered. So what is the amount of ownership in the shadow banking system for Russian assets? And what does that mean for their solubility? Are they going to remain solvent, these shadow banking systems that are out there? Okay, now you add to that picture China. China has a COVID problem. They are shutting down cities like Shenzhen, Shanghai, rolling shutdowns. And what does that do to, again, like Russia, what does that do to exacerbating inflation? And what does that do to global growth? I can't tell you exactly what that means, but it's not positive. And on top of all these things I mentioned is the greatest monetary cliff on top of the fiscal cliff that we've ever had. And what do I mean by that? So we've gone from the average amount of QE from March of 2020 till when it just ended in March, the average amount of QE was about $200 billion a month. That has all gone. That has ended. And now we're going to raise interest rates, the Fed funds interbank lending rate, by increments of 50 basis points. That's what we're told, which is a pretty hawkish Fed. But in addition to that, in May or June, we're going to start quantitative tightening. What is quantitative tightening? Quantitative tightening is the destruction of the base money supply. It's the opposite of QE, which adds to the base money supply, which is the foundation of all monetary growth. We are going to be destroying $95 billion a month. And it's going to ramp up, not in baby steps like it did before. So the first QT started in 2017, 6 trillion in treasuries, and I believe it was 4 trillion, $4 trillion, 4 trillion in mortgage-backed securities. Just not trillion, billion. 6 billion, 6 billion mortgage in treasuries, 4 billion in mortgage-backed securities. And then it slowly ramped up to reach an apex of $50 billion a month. This QE is going to start much higher and only take 3 months to ramp up to $95 billion a month of quantitative tightening. That's a destruction of over $1 trillion per annum of base money supply. This is supposed to happen at the same time that the Fed is aggressively raising interest rates into a very weak economy, an economy that's so weak that it only took one 25 basis point rate hike to invert the yield curve. It normally takes 300 basis points of rate hikes to invert the yield curve, the 10-2 Treasury spread. So you're hiking rates aggressively. You're doing quantitative tightening. You're doing them in conjunction. And it's the most hawkish central bank we've ever seen since Paul Volcker, into one of the worst economic constructs we have ever seen. That is why I'm so bearish.
All right. That is a very compelling and convincing parade of horribles. Michael, as you know, I like to try to summarize for things for guests after a long answer like that. I don't know if I can do that. You had so much packed in there. But real quick, you talked about the huge fiscal cliff. You talked about the massive monetary cliff that's coming. Basically, the rising cost of capital that's going on here. We didn't really even get into the impact that's going to have on things like the housing market or the zombie corporations out there. GDP slowing dramatically from last year to this year. You add in the crushing impact of the true rate of inflation as you calculate it, currently up in the 20% range. The supply issues that are being exacerbated by the return of China to lockdown and the war in Russia. You talked about all the unknown unknowns in terms of the shadow banking system, the pension system, all that stuff, all those players that have exposure to Russia that we're going to start finding out about pretty soon as bodies start floating to the surface. So there is just a huge parade of horribles, like I mentioned, that wrap together all say that growth is going to be maybe a lot less going forward, and asset prices are likely going to have to come down for some of those fundamental reasons, but also a very simple one, which is that there was so much capital being pumped into the system, so much stimulus pumped in the system over the past bunch of years, especially in the aftermath of the pandemic, which is now gone. Right. So, that's like, flying a kite, when you've had a wind at your back for the time it took you to get the kite up there, and then the wind goes away. What happens to the kite? Well, physics says it's got to come down. Right. All right. So let's see. Where do we want to take into from here? Let's talk about inflation for a second, because that's the big news of the day. As you mentioned, the CPI came out this morning. It's at 8.5%, the highest since 1981, over a 40-year high. I think a lot of people are debating right now. Have we just seen the peak of the CPI as reported, or is it going to go a lot higher from here? Let me put it this way. I want to get into all of the disinflation and deflationary forces that you laid out there, but real quickly, let's talk inflation. Do you think that this is the peak here? Because at some point, one, inflation is a year-over-year measure, right?
Yes.
And the last April was when things really started jumping. I think they jumped up from like 2 to 4.5% last April. So year on year, that jump's going to be, going to start coming down on a relative basis. But then also everything you just mentioned is super deflationary, disinflationary, deflationary. So that should start pulling CPI down too. So I guess let's start with, is this March number the peak, or do you see it going higher? Okay, yes, it's the peak.
I think it's the March peak. So we're, inflation, as you so accurately point out, is a year-over-year metric. So we're measuring it against very, very favorable base effects that make it look, well, favorable depending on what your point of view is, but we're not going to have the same issue a year from a year from now, 2023 in April. So a lot of people, I think if I asked 100 people in the street, if I polled them, and if I said prices remain where they are today, what would your rate of inflation be? And they'll probably, I would be willing to bet at least half of them would say, oh, well, 8.5%. No, it's the rate of change, what we're measuring here. So even if gas prices stay exactly where they are and food prices stay exactly where they are, and the price of your steak is still 20% higher than it was last year, and your price of natural gas to heat your home is 20% higher than it was last year, and your rent is 20% higher than it was last year, 2021 compared to 22, and then it stayed where it is in 23 compared to 22, the rate of inflation would be 0. So let's just get that clear. And the reason why we have such a high rate of inflation now, again, is because we paid people $6 trillion. Well, I'm only talking to the United States here, Adam. I'm not talking about Europe and Japan, China. We've done the same thing, the same playbook. We paid them $6 trillion and told them it's too dangerous to go outside and produce anything. Don't make anything. Don't step outside your house. But here's $6 trillion of consumption power to go out and order things on Amazon. And then you have the supply chain bottlenecks that are, an ancillary consequence of that. So you still are going to have the supply chain bottlenecks to deal with, but you're not going to have the same amount of monetary liquidity or infusion for people to go out and buy things with. That is why the rate inflation is going to come down. It's not going to come down to 0, but it's going to come down from 8.5% to say 6%, 5%, maybe even as low as 4% by the end of this year. Adam, if it comes down to 4 to 6% by the end of this year, inflation will still be 2 to 3 times higher than the target range of the federal funds, the Federal Open Market Committee. 2 or 3 times higher. So the Fed is going to have to, in my opinion, be extremely hawkish up front, not only to kill inflation, because they care so much about the consumer, but the administration knows, and the Democrat, and again, let me just parenthetically add that I am a libertarian. So I am not trying to say this to get any Republicans elected, but the bloodbath that's coming in the midterm elections is going to be so monumental that the Democratic Party is panicking, and they will do whatever they have to do to kill inflation, even at the expense of Wall Street, because their constituency, their voting class, needs inflation to be much lower by November. And I believe Biden is putting a lot of pressure on the FOMC to make sure that inflation comes down as fast and as soon as possible.
Yeah, and I agree. Look, I'm no political analyst, but I've been around the block enough to know that inflation is a stone cold election killer, right? So completely agree with that.
Civil unrest, Adam, civil unrest and riots.
Well, we haven't even gotten there yet, but exactly, yeah.
Come out of that. That's when you get riots.
So I've got a note here. I've talked in past years, when I thought things were getting a little out of control about when do the pitchforks come out, and then you add 20% year-over-year inflation, which people can debate that if whether they believe the CPI number or not. But if you look at housing costs, rental costs, et cetera, those have gone up nominally reported 20%. I mean, people are seeing, and most people watching this have seen that type of increase in their fuel prices and their food prices and their housing prices. So, I don't know too many people who could have withstood a 20% cost of living increase year over year if you had asked me that a year ago, right? And even if we get half that going forward next year, there's just fewer and fewer people who I think can truly afford to do that before they have to just start taking it to the streets. And we're seeing that. Sorry, just let me finish it. But we're seeing. So we saw this happen back in 2011 with the Arab Spring, right, in North Africa and the Middle East. Well, we're now seeing it everywhere. I mean, there's if you just type in inflation protests or inflation riots into Google these days, you get Peru, you get Turkey, you get Greece. You get Spain, you get Sri Lanka. I mean, it is getting all over the world at this point in time. And to your point, no matter what they do today, it's going to take at least months to quarters for progress to start to be shown here. And you and I aren't talking about prices coming down. We're just talking about the rate of increase coming down, right?
So yeah, I was going to mention Peru and Sri Lanka. Here's the thing also we have to mention. The Federal Reserve is full of Phillips curve analysts. They believe that inflation is engendered from too many people working. Another problem that we have is that I believe since a lot of these pandemic related relief programs, in fact, all of them, not a lot, all of them have expired. The goods and service sectors, primary beneficiaries, by the way, of this government largesse, have exhausted their savings. And they are going to be returning to the workforce throughout this year. That is going to put upward pressure on the labor force participation rate and downward pressure on the unemployment rate. I believe that seeing large non-farm payroll reports for the majority of this year is going to keep the Fed on the front foot, trying to bring down that number, that nominal number of non-farm payrolls. And what they're going to try to do is, again, try to kill inflation as fast as possible. But they're going to have the Labor Department running against them the whole rest of this year. So look for a very hawkish Fed and no relief coming in 2020.
All right, and two big topics coming out of that. The second one, which we'll get to in just a minute, but right now we have the Great Resignation, right, which is the theme over the past year, right, where people have become a lot more choosy about keeping their jobs and the type of work they want to do. Everything that you've just mentioned in your parade of horribles gets us to slowing growth, probably recession. You mentioned worst bear market of our lifetimes coming too. I want to talk to you about the Great Resignation turning into the Great Unretirement movement. But before we get there, let's talk about the Fed, because I think really that is the biggest macro question right now. You talk about the Fed's going to hold its foot on the accelerator for some period of time, right? But you also said that you see the Fed is at some point, the economy is going to start to crash. It's going to pivot. It's this thing going to return to massive QE. So right now, there's a great debate amongst the folks that I interview, where some think, look, Powell's all bluster, and as soon as he gets to 1% and the wheels start wobbling, he's going to pivot. And then others are saying, nope, he's a lot more serious than folks realize for a lot of the pressures that you were talking about here, and they're willing to sacrifice the markets to get inflation under control. Where do you come down on Powell's level of commitment here?
I want to make myself very clear if I haven't already. The Fed's put is much lower than it has ever been before. Prior to 2022, the Fed's major problem, the major issue, was one of deflation. They perpetually missed their asinine 2% inflation target. The total opposite is true now, Adam. They're at 8.5% CPI. And as you mentioned, 20% in the real life, in the world of reality. And the Fed knows this, by the way. They know they can look at the cost of beef. They can look at college costs, medical costs. They can look at rent costs, new home sales. They know it. They know it's 20%. So the Fed has to sacrifice something. It's either Wall Street or is it the bond market? What do you think is going to happen if the Fed raised rates just 50 basis points and then stopped because the stock market went into free fall? We have a 75 basis point, 75 to 100 Fed funds target rate, which is lower than it was in 2003, which was the absolute catalyst for the real estate bubble. And what if the Fed said, you know what, $9 trillion balance sheet, that's pretty much fine. We're going to keep it at $9 trillion, like that. Banks need a lot of that liquidity. What do you think would happen to long-term bonds? Well, I think the 10-year note is trading at 2.8%, 2.77% as of this recording. You know, where was that bond yield trading the last time inflation was this high? Okay, it was closer to 15%, Adam, not 2.7. Well, that's where that's where if you're going to tell the bond market and the US dollar that, you know what, Wall Street takes precedence, we can never have a bear market. So 8.5% inflation, $9 trillion balance sheet, that's fine with us. You wouldn't see the bond market remaining in single digits very long. And then you have the same problem that you have now, except it's worse. Because now you're having a problem of the Fed has zero credibility. The Fed has zero ability to fight inflation. Oh, and by the way, mortgage rates are now 20%. What do you think that's going to do to the housing market anyway? What do you think that does to the TINA? There is no alternative mantra from Wall Street. So the market's going to crash anyway. You might as well let it have it crash and get something from it, which is having inflation under control, rather than having it crash and have inflation run intractable. That's my opinion, and I think I'm right.
Okay. Like I said, I love that you leave no room for interpretation. You're always very direct and understandable. So I appreciate you being so frank on that. All right. I do want to get to the Great Resignation, but you mentioned the word mortgages, and I want to talk about real estate for a moment because I think you've been really clear so far that you think the financial markets have a big reckoning ahead of them. And if you want to put any general timing on that, please do, meaning like later this year, next year, whatever. But let's talk about real estate for a moment, because that has been such a dependable workhorse in terms of just appreciating year after year after year. We've just been talking about, despite all that, it went up another 20% in just the past year alone, which is crazy. But the big difference this year is cost of capital. So mortgage rates have gone from like 3 to 5+ in just a matter of months. I mean, it's not quite yet a doubling, but it's on its way there, right? In just a quarter or so. That's obviously going to have some sort of effect here. And then as we talk about, a market correction, well, that dampens the wealth effect. As we talk about higher rates, of course, that just raises the cost of capital higher. If we talk about recession, that means people start losing their jobs. All of that has got to break housing at some point. And I've been hearing from more and more analysts recently that even though people can't imagine it, there actually is a fair amount of new supply that's about to hit markets in key locations around the country, which obviously is just going to exacerbate even further. So what is your outlook right now for real estate?
You mean Blackstone might start selling some of their huge hoard of single family homes?
Yeah, well, and you have that risk too, that these new institutional buyers, if any of them gets in trouble, they may have to dump thousands of homes on the market at once, right?
Adam, it makes a lot of sense if you're Blackstone to buy up huge tracts of land and single family homes in the Sun Belt. So to the point where 1 out of every 4 or 5 houses is owned by Wall Street or investors. That's what happens when you take interest rates to 0% and leave them there forever. So the home price to income ratio is at an all-time record high. And if you look at the major problem, 40% of CPI is housing related. Who suffers the most from this inflation? It's the middle and lower classes. Who suffers the absolute most is the people who rent. Rent prices are up 20% year over year. What is the primary function of rent prices, which is the cost of the home? So Powell knows, completely cognizant of the fact that he has to kill and pop the bubble in the real estate market to get inflation under control. And that is exactly what he's going to do. He has $2.7 trillion of mortgage-backed securities on his balance sheet. They're not going to be prepaid. They're not, refinancing, by the way. If you look at mortgage refi, it's down 60% year over year. That's another reason. I didn't add that to my, what do you call it? The list of horrors?
Your parade of horribles. Yeah,
Parade
exactly.
of horrors. Well, I mean, think about what happens when you refi. You say, oh my gosh, I got all this equity in my house and I could refinance my loan. I can get a lower rate, a lower payment, and take all that equity out and go out and on a shopping spree. Well, it's the exact opposite that's going to happen now. First of all, you have higher rates, so you're not going to refi to get the lower rate, and your equity from now on will decrease. And I think it's going to decrease rather sharply. I'm on record. I'm one of the panelists on one of these economic forums that make a prediction for housing. I think housing is 20% lower next year at this time than it is today in aggregate.
Okay, and you're talking about average prices.
Average home prices, 20%. So the second largest drop since 2000, and I think it was 2000.
Okay, great. I want to earmark that and get back to that in a second. I want to pivot in just a minute to getting tactical for the investors that are watching this program and trying to say, okay, how do I start positioning for what Michael's talking about? Real quick, just your quick thoughts on the potential reversal from the great resignation to the great unretirement party here. I'm presuming, given everything you talked about, you think that the outlook for jobs is probably not going to be that great looking ahead the next year plus or so, as potentially recession hits, companies retract, maybe start laying off people, whatever. But don't let me put words in your mouth. What do you think is going to happen with the labor force going forward?
I think there's going to be a lot more people that are forced to join the labor force in the short term. I don't know if they're all going to get jobs right away. I think a lot of them will get jobs right away, which again will drive up that nominal non-farm payroll number. But if you look at leisure and hospitality, that's the sector that gets hurt the worst in a recession. I think they'll be laid off in droves by the end of this year. I don't know if we're wrapping up this interview yet. I hope we're not, because I have
no. We're just getting to the good part. We're just getting to the advice about what to do as an investor. So finish this macro part first.
So there's nothing that's going to save you this time. In 2008, China saved the economy by going this grand, borrowing scheme and reconstruction scheme, building empty cities and buying commodities all over the planet. Well, China just came out with a producer price index. I believe it was yesterday, 8.3% year over year. China now has a huge inflation problem. If you look at the home price to income ratio in China, it's now 14. It's about 14. Some cities like Beijing, it's in the 30s. So if we had a home price to income ratio to get median family income in the United States, the average home price in the United States would be $1 million. The average. That's how crazy their real estate market has become. How unaffordable their real estate market has become.
Sorry, I just have to opine, since I live in California. I'm like amateurs with an average $1 million price.
Well, I mean, the average.
But no, what you're talking about is crazy. I mean, this is China. This is where real estate was on a relative basis to the U.S. I mean, pennies, and now it should be valued at $1 million. As you're saying, I mean, that's a crazy relativistic jump.
The median home price in the United States is half that. It's less than half that. So yeah. It's you can't. In other words, you cannot fix an inflation problem with more inflation. You can fix a deflationary problem with inflation. That's how we fixed every problem since 1987. But the Fed cannot come to your rescue. China cannot come to your rescue. Russia never came to your rescue. But again, they get a shadow banking system. Again, Did they all get out of their equities and all of their bond exposure prior to this invasion? Who owns all this debt? I mean, you're going to have a lot of confessing coming up in the next few quarters. So again, the Fed can't save you. China can't save you. Nothing is going to save you from this. The only thing that can potentially mollify the situation is if inflation plunges from where it is today to 4% or below in the next few months. I think the chances of that are very, very slim.
Yeah, and really, the only way that inflation is going to be brought down at this point in time is going to be by demand destruction, right? You're nodding heavily as I'm saying this, right?
Correct.
And demand destruction is highly disinflation than deflationary, right?
Adam, you could, if I could afford you, you can come work for me. It's exactly the predicate here is that disinflation will happen later this year. That could and should morph to deflation if we have a credit market freeze, but growth is going to crash much harder and much sooner. I have to mention, Europe is not going to bail you out either. You know that in the past 2 months, Europe hasn't been able to float one junk bond. Their junk bond market is completely frozen. I think we're going to have disinflation morphing to deflation later this year, where once again, our credit markets freeze. And that's going to be a huge problem for the stock market. Now, again, I own an RIA, SEC registered RIA, and I have an actively managed strategy. And I don't want to suffer a stock market that goes down 30 to 50% if I don't have to.
All right, so sorry to interrupt, but let's dive into that right now. Let's make the pivot from, okay, we see this horrible macro situation coming ahead of us. Michael Pento, what should today's investors be considering based upon the lens that you look through? If they want to avoid that pain that you're saying you want to avoid too.
Listen, so for the past 6 years, I've had this inflation, deflation, and economic cycle model. It has 20 components.
This interview with Michael will continue over in part 2, which will be released on this channel tomorrow as soon as we're through editing it. To be notified when it comes out, subscribe to this channel if you haven't already by clicking on the subscribe button below, as well as the little bell icon right next to it. And be sure to hit the like button too while you're down there. Last, if the sobering market outlook Michael has detailed in this interview has you feeling a little vulnerable about the prospects for your nest egg, then consider scheduling a free, no strings attached portfolio review by a financial advisor who can help manage your portfolio, keeping in mind the trends and risks Michael's mentioned here. Just go to wealthion.com and we'll help set one up for you. Okay, I'll see you next in part 2 of our video interview with Michael Pento.